What's going on, everybody, and welcome to another episode of the Leveraging Real Estate Podcast. My name is Ryan Corcoran, as always, your host, and today we have a very special guest. If you're anywhere from New England or New Hampshire, Maine, anywhere around that area, you've probably heard of this guy before. He's got a great podcast. He's got a great social media. His name's Axel Ragnarsson. How are we doing today, man?
I'm doing great. Appreciate you having me.
Absolutely. Looking forward to this. I think, I've learned a ton from you. I think the audience will be able to learn a ton from you. And we're pretty close in our stories. And so I think it'll be cool to get you on here and share what you know. So let's just start from the beginning. Who are you? Where are you from? And we'll get into how you got into real estate.
Yeah, so I grew up in southern New Hampshire, a very small town called Chester. It's about 30 minutes south of Manchester for anybody that knows southern New Hampshire, which is not many people. But I grew up in New Hampshire and went to college in New Hampshire, and then I moved to Boston after I graduated. And while I was in college, and even to back up further, I always had kind of the entrepreneurial upbringing. Was always buying, selling stuff to make money. I was flipping baseball cards, electronics, golf clubs, whatever, right? And started buying and selling cars to make a little bit more money, and that was something that I was doing in college. And at some point, I was like, what can I do that's a little bit bigger than this? And I think I literally Google searched like. What do wealthy people buy and sell? And real estate inevitably kind of came up. So I found Bigger Pockets, started to learn about real estate, and I wanted to actually flip houses. And this is like my sophomore year of college. And the more I was learning about flipping houses, the more I started to learn about passive income and rental real estate and multifamily real estate. And I decided that was a more attractive route to go because flipping houses is just really risky, and I wanted to get into something that was a little less risky. So started looking for deals, started trying to find, off-market, direct-to-seller, small multifamily deals, and ended up buying one in college. And, basically financed that with some private capital through a private lender and started snowballing that portfolio. And then I graduated school and moved down to Boston and took a job. And took a sales job. It was a, really good job, great opportunity, growing company, came with some equity. But it was extremely demanding. And originally my plan was, all right, I'm going to work this job. It's going to be my W-2. I'm going to go buy real estate on the side. Even though, I knew I didn't really want a job. Like, I was like, I'm not going to be here for that long. This is just to get me to a point to where I have enough income coming in to then quit the job that I just took. Mm-hmm. And 3 days in, I had a seller that got a direct mail piece from me. He called me while I was at work, couldn't answer the phone. I got home, listened to his voicemail. It was a 12-unit deal in Manchester, New Hampshire, which was my target market. He was just trying to give it away. And so I quickly called him back, and he's like, I just put in a contract with another owner, or buyer, I should say. And next day, went into the office. This is day 4 with this job, and I said, I can't work here. Like, I just left 6 figures on the table yesterday. This is insane. So I was there for 3 days, and then after that, it was full-time real estate. I got to figure out how to do this full-time, and started focusing on finding great deals. Started focusing on bringing in investors and trying to creatively structure deals to just buy deals because I didn't have that much money. And that was 5 years ago, and since then the business has really developed into a true deal engine. We go out there, we do a lot of marketing, as you do, Ryan, to go out and find deals. And we raise capital to buy those deals. And now we do some deals in Florida. We have a deal out in Indianapolis. We've expanded in a couple of other markets. I'd like to describe our core focus right now as central and southern New Hampshire and central Florida because we have great infrastructure. We've done a lot of deals in those markets. And we raise capital from investors to buy them now. So, the last 12 to 18 months, we've really gotten serious about that. We've started bringing a lot of passive investors in our deal and starting to utilize the syndication structure. Mm-hmm. But it all spurred from just finding great deals and using the Burr model and just creating that big snowball.
All right, so real quick. So you had this job for 3 days. You quit the job. You decided you wanted to go into real estate without owning a property, which you bought one property before that, right? You said
I was up to 3. I think I had 9 units or so. Yeah.
Okay, got it. So how were you able to fund marketing and because I'm sure with 3 properties you can make a little bit of money, but how are you really funding your marketing and your targeted direct mail and direct email, whatever you're doing? How are you able to fund this to lock up these larger deals?
Yeah, so when I quit the job, I was under contract on deal number 4, which was a 3-unit deal in Manchester, and I had 9 units before that, and just needed money, so I sold one of the properties I owned, and this is a entirely separate tangent, but I've never been afraid to sell properties. Like,
Yeah.
I've never been married to the idea of keeping that passive income. You know, so many people, they don't want to give up that passive income, but, you know, and they give up the empire for the little pot of gold because they don't want to give, you know, they don't want to, a few $100s a month. It's nice. It's dependable. I was like, no, I need all the money that's tied up in equity there so I can go do marketing, right? And so that I can pay my rent. So for me, sold one, right? That brought some cash back into the quote unquote business, right? It was just me. And then I started investing a little bit in marketing, but to be honest, most of my deals didn't come from direct mail or paid marketing. They came from prospecting, right? I was emailing owners, I was calling owners, and I was just really, really pounding the network and telling everyone, hey, this is what I'm looking for if you know of anyone that's selling, right? So a lot of my deals are coming through relationships and prospecting, and direct mail supplemented that, probably helped with the brand awareness a little bit. It brought a deal here and there, but for me, I was like, I'd buy 2 deals, I'd sell one. Then I'd buy 3 deals and I'd sell one. Then I'd buy 4 deals, maybe sell 2, right? And the deals I was buying were a little bit bigger than the ones I was selling. And in aggregate, the portfolio grew. But I knew I had to keep, I had to buy a deal, create value, create equity. And every once in a while I had to sell, right? I'd try and refinance as many as I could. But I knew I had to sell some, right? Because I needed access to that cash. Cash sitting in equity, earning you, 8% return on your equity from the cash flow, can be better utilized to grow your business in a forward-looking fashion.
Let's talk about that for a second. So a lot of people look at, a return on the money you put into a property. So let's say, you have to put $100,000 into a property. What's that going to get me on a return based on that money? But what a lot of people don't look at is, all right, when you go and rehab that property and you improve the value, and now you have, let's say, $200,000 in equity. What are you returning on that equity portion of it? And if you could take that money and go earn more somewhere else, it probably makes sense to sell that property, right? And so I'm curious, is that how you determine, well, besides the fact that you might need some cash at some point, but when you're looking and analyzing your portfolio on, hey, maybe it's time to sell this property, what are you looking at? Is it a return on that equity? Is it just not performing as well as you thought? How do you go about that?
So from a financial analysis standpoint, you're absolutely right. Return on equity is the metric, right? That's the most critical metric that we can evaluate. And, there's a whole nother conversation about what's your goal in doing all of this, right? Some people's goal is they want to go buy a duplex every year for 5-10 years, and then they can use that to retire. My goal was like, I want to grow a portfolio now. Like, I want to do this yesterday, right? So I knew that I had to be maniacal about the velocity of money concept. I had to buy a good deal, so I didn't bring a lot of my own money. I had to create the value, and then I either had to refi to get my cash or I had to sell it. And usually once you're done with your value add process, right, these small multifamily deals that take 6-9 months, you're done with the deal. You've done your renovations. You're all into this project for $500,000, and now it's worth $650,000. And maybe you already had some equity as well. So now you got, call it $200,000 in equity in a property that's now spitting out, if you're really being honest with your fundamental analysis and taking money out for CapEx and all of that, and you're really being honest with what it's going to need in the future, maybe it's bringing back, I don't know, $10,000 a year, something like that. So I'm like, yeah, that's great, right? And most people don't want to give up that $10,000 because they really like the feeling of that coming in, right? And oftentimes they don't know what to go do with the money if they were to sell it. So if that's your situation, yeah, maybe you hold on to it, right? If you don't have anywhere to put it. But for me, I always had opportunities to put it in, right? So I'm like, do I want to earn 5% on this? Maybe it's making $15,000 a year. Do I want to earn 7.5% on my equity? No, like I need to earn 50% on my money to get to where I got to go. And this is not even remotely in that ballpark. So that's the financial analysis part. And then the other piece of it is, do I see this as a property that I want to own long term? And honestly, if you have a portfolio and you're looking at your portfolio, I bet you there's a large segment of properties you're like, I don't see myself owning that for a long time. Maybe it's too small. Maybe it's not in the area that you like. Maybe it's not maybe there's some big ticket CapEx. Maybe you're going to have to replace the roof in a couple of years and you're kind of dreading that. So that's the emotional question. That's kind of the emotional part of it. Does this fit into my long-term vision? And then the other piece is, the financial analysis, which, challenge for everyone listening to this podcast. Go sit down. Look at what you own a property. Look at what the market value is. Look at what you could net if you sold it. Be honest with yourself about what it brings in. Is that really a good return? Are you happy with that return? And, it doesn't account debt pay down, and it doesn't really account, maybe future cap rate compression, which, basically just a fancy way of saying prices going up. But if I can make more money today with that money, and the most profitable activity and action an investor can take is finding a really good deal below market value and buying it. That is the activity that makes the money, right? So I want to go take my money out, put it into a deal where I just bought it at $700 and it's worth $850 the day that I close,
Yeah.
I've just doubled my money the day that I close.
Yep.
That is much more profitable than leaving it sitting, in another deal.
Yeah, I 100% agree. And you're a huge proponent of this. I see it on social media. You're big on social media and posting this kind of stuff. And it's, why are people afraid to sell? Right. And so when I first started investing, I was, my thought process was, all right, well, I'm just going to accumulate all these properties and I'm never going to sell them. Right. Why would I ever sell them? But then if your model and your mindset is scale, you can't get stuck holding onto a property making you 8 or 10%. It's just not, it's not realistic if you're trying to scale. You can use that 100, 200 grand, whatever it is, to go buy something that's going to make you an infinite return when you pull that money back out of a BRRRR, right? So I think it's really interesting. I like your mindset on this and how you go about running and scaling your business with selling properties, because I don't think a lot of people look at it that way.
Yeah, when you're starting out, you like the idea of playing Monopoly, right? You want to own a lot of property, and then you realize that that's not financially the best decision, oftentimes, right? And this is all with the asterisk. It depends on what your goals are. If you love your job, if you don't want to be stressed out about having to go out there and find more deals and do this direct to seller stuff, and you just want to go buy a duplex off the MLS every year, perfect. Like that's great, right? And for the vast majority of real estate investors, that's typically what the strategy is, right?
Yeah.
They want to supplement their retirement. For me, I was like, no, I want to build a business, right? I want overhead. I want to. At some point, I want to hire a staff. Like I want to get to 1,000, 2,000 units, right? And you don't get there by holding small multifamily properties.
No.
You need to use that to make the money to go out and buy the bigger stuff.
Yeah, agreed. All right, so with all that said, what's going on right now? What does the business look like today?
Yeah, so right now, we own a couple hundred units up in New Hampshire. We're always buying and selling up there, right? We have a great operation. We're vertically integrated. We have a property management company. It's a well-oiled machine. We own about 150 units down in Florida, and those are all joint venture deals. So I don't personally own all of those. I have a couple of partners and some investors, and I want to just keep buying in those two markets. At some point we might, really intentionally expand into a third. In terms of when I say intentionally expand, I mean we're going to start expending resources as it relates to marketing, trying to find deals, networking with brokers, other investors, and building out the infrastructure to be the main operator. Sometimes I work on other deals that other people have because they need help raising capital, and I trust them, I like them, I know that it's a good deal, so we'll partner in that capacity. But in terms of deals that we operate and we find, those are our two main markets, right? And I'm spending a lot more time building out the capital side of our business because personally I get a reward when somebody participates in our deal, invests 25, 50, 75 grand, and they do really well financially, right? There's an element of reward, and it helps to fuel the growth of our business. So it's the definition of a win-win. So we're starting to put together some creative structures. I don't know when this episode will go live, but we're about to launch an open-ended fund to go buy real estate. It's going to be a 506c, so we can advertise it, and people can come in and just ride shotgun on the deals that we do direct to seller, and they can gain exposure to multifamily, in New Hampshire, for example, with that strategy. And so for me, I'd like to focus on larger deals because it's more scalable, and it's a slightly better use of my time and everyone in my team's time. But it's really hard to turn away good deals even if they're smaller. So we're going to build a medium to execute on those deals while also trying to more actively focus on the 50, the 60, the 70 plus unit assets. Okay, so to do this, you've got to have a team in place, right? So what does the team look like right now? I mean, you can't be doing a 6 unit, an 8 unit, a 10 unit, a 100 unit. Like, you can't be doing it all at once by yourself, right? So you've got to have some sort of integrated team here. So what does it look like right now? So we have, full-fledged property management team, property manager, maintenance guys, leasing agents, all that stuff. I am absolutely stretched to my gills in the investment side of the business right now, right? And I'm actually trying to make a W-2 salaried hire and kind of an operations role to help with asset management, to help transaction coordinate, to help a lot of this stuff, right? Because that's where the effort comes in is transaction coordinating all these smaller deals is like it's just death by a million documents, and it takes so much time to do that. So for me right now, that's a hire I'm looking to make. I have somebody part-time helping me out with that right now. I have, a couple of VAs helping me out with all the content stuff that I do. And, at the moment, that is my bottleneck is people in my organization, right? I need to start building a payroll, true W-2 salaried payroll, which I'm in the process of doing right now. And, like the last number of months I've been stretched, and now I'm like at the breaking point. So I brought in somebody part-time to alleviate that constraint in the short term. But that is the operational complexity that comes with focusing on, or not focusing on, but just being willing to do smaller deals. Is it's just the same amount of documents, same amount, it's still a weekly call with a property management company, and it's not as scalable. But for us, we know we do those deals in our sleep, and if I don't have to personally pour my own capital into those deals, and I can offer a really attractive investment opportunity to investors while also being able to capitalize on those deals, then it's a bit of a win. So it's just a matter of we need to get some payroll in, and then we can start, actually expanding.
Yeah, because, it's ultimately the same amount of work to buy a 3-family it is to buy a 15, 20, 30 unit, right? I mean, there's more. It's more complex, obviously, right? But it's the same steps, right? You find the property, you lock up the property, you go through all the documents, you get you get the money to close it, and then you manage it, right? So it's essentially the same, but the benefit of going larger clearly outweighs the smaller ones, right? Especially as you start doing these, the more units under a roof, or the more units in general, it just starts to look a lot better. The price per unit starts to shrink. The price per rent starts to increase. Shrink. It's great. So I'm fully on board with that. And actually, the last time we spoke, we were talking about hiring because I was doing everything myself. Since the last time we spoke, I've got 2 VAs, and I actually just hired a full-time assistant and bookkeeper as well, W-2, because I was also at my breaking point, right? Like, we've got 7 or 8 transactions just this month, and it's virtually impossible for me to do all that, right?
You can't keep up with that.
No, you can't keep up with it. Dude, I showed up to the closing table the other day, and I forgot to get insurance on a property, so I had to call my insurance agent while I'm at the closing table and have him buying cover. It's just like, stuff like that is not sustainable to run a successful business. And so, let's talk about hiring real quick. I think this is huge because a lot of people are really hesitant to hire. Because, for example, like, all right, let's say you're making a decent amount of money, but you're spending a lot of it on putting on down payments, on rehab. There's not a whole lot sitting there left over. How do you pay for these people, right? How do you pay for employees? And when is it the right time? So let's jump in. So I like your thoughts on this.
I'll share, I'll touch on a couple of those too. I mean, and let me, big asterisk, grain of salt announcement here. I am not an expert at hiring internally, right?
None of us are.
So take all of this with a grain of salt. I'm going to pair it, I'm going to be the parrot for the people that have told me what to do that I trust. So I'll still bring some value in that respect, but I can also touch on some other key elements of what you're describing. So first of all, people that are in real estate think they're investors, not business owners. That's a broad statement. Most people think they're investors, not business owners. Everyone's a business owner that's in real estate investing. So flip that script in your mind and understand that to grow a business, people need people. So fundamentally, that's the mindset shift that has to occur for you to grow a real estate business beyond what you're capable of doing, right? 20, 30, 40, 50 units. If you self-manage, is your max. If you have third party, maybe you get to 100, but beyond that, it's going to get really tough to grow the business. So here's what I do, right? I had, we got to pay for this somehow, so we sell properties. We have to be willing to sell to bring cash back in the business. The second thing is we structure our deals with some small fees, right? We're not a big fee shop. We charge an acquisition fee on some deals if we're raising capital to do those deals to compensate us for the absurd amount of work that goes into getting that deal under contract for our investors. But again, we don't even charge a lot of fees. We don't charge asset management fees or disposition fees or capital transaction fees or any of that other stuff that most people charge. I just charge an acquisition fee just because you got to make that cash register ring a little bit in your real estate business if you're raising capital, right? That's the caveat here. Or if you're doing it yourself, create an LLC for that property, fund that LLC, pay yourself a fee, right? You got to start getting in the habit of treating this like a business.
Yep.
So those are the two, call it revenue generators, right? And then every once in a while you get a cash out refi, and you get these lump sums of money coming back. That's how you pay for this stuff, right? You put aside a year's worth of salary as runway, and you don't touch that. You don't invest it in a deal. You don't put it down as earnest money deposit. That's call it your payroll. So that's how you financially make this work. You don't go out there and try and pull it from your cash flow, and that's just you're redlining your car is the hypothetical analogy there. So that's kind of step one, paying for this. Now, two, there's 2 different types of hires you can make. You can make an internal hire, W-2 or 1099, that's full-time with your business or part-time with your business. You have to manage them. You are the one that trains them. If you suck at management, training, and as a leader, they will suffer. And that's where I'm spending all of my professional development right now, is trying to get better at that, because I know that's the next stage of what I have to be good at. I'm no longer a deal guy. I am, in a sense, but now I have to be a really good manager and leader, and I have to be a good operator of a business, right? There's a difference there. The other type of hire is external. You can outsource things, right? So some examples of things you can outsource. You can outsource finding banks to lend you money, right? You can hire a mortgage broker, and you're going to pay them. They're going to go do that for you. They're going to source debt for you, right? And they're going to be better at it than you probably are.
Yep.
That's something that you should do. 2, you obviously can hire a real estate broker to sell your properties, right? That's an obvious one. 3, property management company. That's an obvious one. Then where it starts to get a little bit more unique is, you can do insurance brokers. They take that off your plate. Again, use an insurance broker. Don't try and do this yourself. You can hire a third-party bookkeeper. Maybe you don't have a full internal need for a bookkeeper. I have a bookkeeping service. They probably work 8 to 10 hours a week. They bill me their time. Yes, it's more expensive than an internal person, but I don't have to spend any of my brain power on that. Mm-hmm. But basically, you can outsource. You can outsource your direct mail. You can outsource. There's a company called Call Porter, right? Ryan Dossey, very successful direct-to-seller real estate investor. They take your calls for you, right? In terms of your inbound calls, and then they give you the summaries. So if you start to look at all these different activities, you can probably find vendors that can do a lot of this stuff for you, right? Don't GC your own construction projects. Hire, a GC to do that. You shouldn't be subbing out the paint, the flooring, the electrical. That's going to drive you insane. So the first thing you want to do is you want to max out all of the vendors that you can utilize, all the third-party vendors to buy your time back. Yes, they're going to charge you $75 an hour. Your time's worth more than that. If you're a real estate investor trying to grow a business, you can't do $75 per hour tasks. You have to do $150, $200 hour tasks.
Yep. Or more.
So you get all that stuff off your plate, and then whenever what's left, which is typically coordinating transactions, it's asset management, it's it's a lot of content stuff. If you have investors, it's investor relations. It's doing all of that stuff. That's when you start to bring in a full-time internal individual, which is exactly where I'm at right now. And I should have done this a year ago. Yeah. But I just said, I'll work 80 hours a week because I suck at hiring and managing. And now I'm like, I just need to get better at this. I need to be able to identify and hire the right people. Mm-hmm. And from a hiring standpoint, and then I'll shut up after this, but from a hiring standpoint, you can go 2 routes. You can go the build it route, or you can buy it. Build it is you hire someone that doesn't necessarily have the skill set yet, but they're a little bit cheaper, and you can train them up. And that's going to be much more time intensive. You're going to need the skill sets as a manager to bring them up to speed. Or you can go the buy it route, where you have the guy who's already winning the gold medal for the other team, and now he's just going to come and win it for your team. So you got to pay up for that person, but it's less work from a training standpoint. You still have to manage them. You still have to set the vision and lead. But that it's just 2 different strategies, right? Do you want to go less expensive and train and build and cultivate, or do you want to just bring in somebody that can already do it and then you just plug them into your operation? Yeah. I'm trying to go the second route. I'd rather overpay because I have enough self-awareness to realize I'm not a good enough trainer to sit down and get on a Zoom call for 2 hours, on a Monday, and this is how we do this. I want you to come in and tell me what to do. Like, I have my own process. We'll collaborate on it, but then I want to set you loose in my business and give you autonomy, and we'll chat. So I'll summarize the whole hiring conversation with that specific piece of it, but get everything out to vendors and third parties and then start to bring stuff in-house.
Yeah, I think that's awesome. I think that's great advice. I think everybody who's at the point where it's, hey, maybe is it time to hire, should go back and listen to that last 3 or 4 minute spiel right there, because you've gone through it. I've gone through it. A lot of investors we know have gone through it. And I don't think anybody has ever regretted hiring somebody. It may not have went well, right? But they learned from it. And you're able to offset some of your tasks and allow you to spend more time on that $10,000 an hour task instead of doing the nitty-gritty things like lining up an insurance, right? Like that should be something that you pay somebody to do. All you do is sign the documents, right?
Finding great real estate deals is easy comparatively to effectively hiring, leading, and managing.
I agree.
That's the hard part. The easy part is getting a guy to sell you a property for $400,000 that's worth $5. That's much easier than getting somebody in your organization that is a true value-add A player. You can hire anyone, and your business can grow, and they could be a C+, B player, and they do their job. You probably have to spend a little too much time managing them, but and this is now you're going to get a window into my crazy brain. But in real estate, we're always looking for inefficiency, right? We want the inefficient markets, the inefficient pricing, mom and pop sellers that don't know what they have. Hiring is the same thing, and there's more inefficiency in human capital, right, than anything else. In terms of, you hire someone that's an A player and you're paying them like a B+, that's creating so much more value on the dollars that you're investing into that person than a real estate deal, even if you're finding an insane one, right? So, but it's much harder to identify that person, and it requires a completely different skill set than being a good deal guy or a marketer or a sales guy or a finance guy. Yeah. So, I think that's not to discourage people because a lot of people are struggling to find off-market deals, right? Nail that down.
Well, it's just a different level, right? It's a different level, right? If you're starting, finding deals is probably the most important thing you can do. At least in my mind, and I'm sure for you as well, right? If you can find the deal, everything else will fall into place. But after you've mastered that, it becomes, okay, I need to become the leader here and turn this into a functioning business instead of me going out finding all the deals. Because that'll get put on autopilot eventually. All right, so with all that said, real quick, you said you had some VAs. So are they doing social media for you and stuff like that, or what? Yeah.
Editing podcasts, creating social media graphics, creating social media, videos.
Yeah.
I've gone through a couple. It's hard. It's really hard to manage. I'm at the point where I've worked with a lot of VAs. I think VAs are great. They oftentimes have comparable skill sets to folks you can hire within the States. It's much more economical. But again, you still have to show up and train, right? Even if you don't even know what you're training for, you still have to kind of set the vision.
Yeah.
And it's a struggle. It's you have to be on the phone a couple times a week, right, to check in. And unless you have a true rockstar, autonomous individual that literally does not need guidance, you gotta be there, right?
Yeah.
So for me, that's the struggle, right? I just want to talk on Monday. I just want you to here's the objective. Just do it, right? And it's so hard to get to that place.
Yeah.
So, but that's what they're doing. They're doing a lot of social media stuff for me. I had a more general kind of purpose VA that was helping me with some internal projects and helping me to do a lot of that stuff. But and it's immensely helpful. And I think working with a VA is hiring on with training wheels. Very low risk from a monetary standpoint. You can start part-time. You can
$4 or $5 an hour, right? I mean,
$4, I'm paying my guy $750 because he's a great video editor. And it's like it's $2 an hour. Like I just I'll pay you a little bit more and you'll just stick with me for a while.
Yep.
But for me, it's just like, all right, here's your here's your junior varsity training program for hiring. So that's how I look at it. And for really autonomous work, or not autonomous, repetitive and kind of structured and just work that's being done on an ongoing basis that you can easily put together a system for, VAs are great.
Yeah.
And I think everyone should just hire one, even part time. Spend $300, $400, $500 a month on a VA. If you can't afford it, figure out a way to afford it, because getting the reps in with somebody in your organization, it's going to feel good to just throw stuff in a different direction other than knowing you literally have to do everything yourself.
Yeah, I agree. I've got one right now who's doing a good amount of cold calling, entering into the CRM, managing the CRM. Basically, I don't do anything on my CRM anymore, which is fantastic. And she actually, which is great, is I basically said, hey, I want to get on a bunch of podcasts, right? So the next day, she emailed 13 different podcasts. I got on 4 podcasts, and I didn't have to do the work. I don't have to go find the people, find the hosts, and email them. Done, right? And then the other task she did was she interviewed social media managers because I wanted to start getting that off the ground. So she went out and found a bunch of VAs and interviewed them all. And she's like, okay, I've narrowed it down to 2. I set you up for meetings on Tuesday, right? And it's just little things like that at a very small monetary amount that brings so much value.
So much value.
Yeah. So, all right. So let's move into what is the future for Axel's business here.
Yeah. So, I think then if we call the future, next 12 months, and then I'll do maybe next 36 months, 3 years. Next 12 months is, from a personal standpoint and an organizational standpoint, not real estate. I want 2 salaried folks in the business that are really making my life easier, so I can focus on larger deals in capital. Those are the 2 activities that drive all of the income for a real estate investor and a real estate business owner. So those are the 2 that I want to spend time on. Mm-hmm. So I want to find a great operations person to really spearhead operations. And then, somebody else, maybe it's an asset manager or some kind of investor relations person. Maybe it's more of an executive assistant role. But those are the 2 folks that I want to hire for in the next 12 months. And then from a real estate standpoint, we're on track to buy, I don't know, maybe 180, 200 units this year. I want to buy the same amount of units this next year, but I want those deals to be higher quality. Door count is irrelevant. The sooner everyone embraces that fact, the better. It's not about how many doors you have. It's about the quality of your doors and the pricing of the doors that you're buying.
Yeah.
I want to buy more expensive doors in nicer areas. I want to buy, instead of buying 200 units at $75K a piece, I'd rather buy 150 units at $100K a piece, or even better, 100 units at $200,000 a door. So I want to tighten up our operations and our criteria a little bit so that we're buying in great areas at pricing that makes sense, but allows us to, there's more value to be created in larger deals. So that's kind of a real estate goal in the short term. The next 3 years, and this is kind of a really big, audacious one, but I want 1,000 investors to have participated in our opportunities, passive investors at any level of investment. So, we obviously need to build out the deal flow to support that kind of investor interest. So, we'll work that out and figure that out and establish the relationships to do that. I think if I get myself out of the business, even more so than I already am, that's extremely achievable because investor interest in your deals compounds. If you have 4 investors in your first one and you execute really well, communicate really well, and provide a great experience, they're likely going to refer you. And maybe you get 8 on the next one, and then they're likely going to refer you, and maybe you get 16 on the next one. So in 3 years, I'd like to get to 1,000. It's probably not going to happen, but who cares? Maybe I get to 700, and it's a huge.
What's your game plan to do that? Is it social media? Is it newsletters? So how do you plan on getting your business's name out there? Because I'm really curious on this because I've pulled in a bunch of investors as well, but I've found it actually pretty difficult to.
It's extremely challenging.
Yeah, very
to
challenging.
Find investors.
Yeah.
People think there's the adage of like, oh, if you find the deal, the money will come. No, it just won't. So, it's way easier to find deals than it is to find capital. And when I say capital, I mean retail capital that you are personally raising, not a partner that brings the money and takes a part of your deal. So those are two distinctions to make. You can find a great deal and find a guy who has the money, and then you're going to share in the upside. But if you want to be finding deals and raising the money through your network, that is very challenging to do. So the route that I'm going to go is it's all personal brand oriented. So I want to grow the podcast. I want to grow the social media following. That is what drives a lot of the original investor interest. That's what gets you from 0 to 15, 0 to 20 investors. And that's where I'm at right now. 20 people kind of regularly participate in our deals. But the other thing is I want to start going full cycle on a lot of the deals that I've already bought. So we're selling 2 deals right now that were, deals we raised for a year ago. We're going to be refinancing a portfolio soon and getting a big chunk of capital back to some investors in a project we have up in Manchester. And stacking those big wins, distributions are nice for an investor, but be like, ooh, I just got a big portion of my principal back. Or we went full cycle and I'm seeing how much money I made. That's what really spurs referrals. So social media gets you to like 100, right? That gets that snowball going. And then consistent production and execution, that's what rolls that snowball down the hill. So to get to that 100, it's all social media, it's all personal branding. It's probably a little bit of direct outreach and really starting to build out that infrastructure. A newsletter is another thing that I'm starting to get a little bit more consistent with now. Something that I want to do is probably start offering some online courses for active real estate investors and maybe like a community, right? And I don't want to be a full-blown guru who's out there making that his whole business, but I think I can provide a lot of value through an online course format with an associated networking group, and that just builds, that rising tide lifts all boats, right? So that builds the overall brand recognition, builds my network, brings more people into the ecosystem, and eventually the more people that know you and are seeing your opportunities, you just organically start to raise some more money. So I think those are the strategies, and it's hard to really nail it down beyond that, right? I just I'm not a big reaching out to that guy, asking him to invest. I'm a big build the audience and the money will come.
Well, dude, it's been fun watching you grow so far, so I'm excited to keep watching it and be a part of it. We're about 3/4 of the way down here. I just want to touch up on something that I know you're very good at, and if not the best at it, that I know, and that's funding and basically creative financing to take down deals. And so I know you've got a couple of different strategies that you use. I think it would be great for the audience to hear how you structure these deals. I mean, I know they're all different. Some seller finance, private money, blah, 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 blah. Let's give 2 or 3 examples of deals that you've done using creative financing that the audience can almost like mimic to a sense.
Sure. I'll give you 3, and maybe if we have time I can give you a 4th. But number 1 is leveraging private capital in terms of lending on the buy side of a deal. And I'm going to just say, before you can use any of the strategies that I'm about to get into, the fundamental constant is the deal has to be good. You have to be getting a discounted deal. You can't pay market for a deal and then do any of this stuff. So that's to be, assume that, right? We're buying deals at 20-25% below market value day one, and then we can start to do all this stuff. So, the first strategy I like to use is just higher loan to value on the buy side to minimizing the amount of cash I got to bring. So hypothetically speaking, let's say you're paying $400,000 for a property, it's worth $500,000. You're buying it 20% below market value. If you go to a bank, they're only going to give you $300,000 because they're only going to give you 75% loan to your purchase price. They don't care what it's worth right now. That doesn't matter. That's not going to change what they'll give you, right? In a traditional bank scenario. But let's say you go out to a private lender, you're going to pay a little bit more in interest, but oftentimes it's worth it. And maybe he's willing to lend you, she's willing to lend you $375, $385, or $400, the whole darn thing. Most people think, oh, you're over leveraged. Well, no, because now I have a $400,000 mortgage, which was my purchase price, on a $500,000 property. That's 80% loan to value. 80%,
right? Yep, exactly.
Yep. So we're back to where a bank probably would have given me
if you bought it for market, right? Yeah, exactly.
Exactly. Mm-hmm. So, and you can do some stuff to support that, right? Go get a desktop appraisal, go get a broker price opinion, say, hey, this third party said this is worth $500.
Yeah.
This is why you're, and maybe they want to see some skin in the game, so they give you $385 or something, but you're bringing less money to the deal. Now, that's number one. Number two, utilize seller credits. Seller credits are so powerful, and it just, it's such a great way to reduce the amount of money you bring to closing. Mm-hmm. So, again, same scenario. Let's say you're buying a property for $400K that's worth $500. You go to the bank, they're going to give you $300, right? You got to bring $100,000 down. Or you can structure the deal in a way that you tell the seller, I'm going to give you $450K. But I want $50,000 as a credit at closing to reduce my cash out of pocket. So you're going to walk away with $400, and maybe he's got to pay a little bit more in transfer taxes. So maybe you got to pay him $405, right, or something like that. But for example's sake, let's just say I'm going to give you $450. You're going to give me $50 at closing as a credit against everything I got to bring, and you're going to walk away with the same as if I just paid you $400. So now let's do some quick mental math here, right? So if you're going to do it in the first scenario, you under contract for $4, bank gives you $3, you bring $100. Now, if we do this scenario, bank's going to give me 75% of $450, right? Which is, I don't know, $332 or I don't know, something like that.
Around there. Yep.
Yeah. So I'm going to have to bring like $112,500 to closing in this scenario, but I'm getting this $50,000 credit from the seller, so now I only have to bring $62,500, right? Mm-hmm. That's a great way to reduce your cash out of pocket. Now, the asterisks here are you got to get the lender on board. They have to be okay with this.
Yep.
You're going to have to, have a conversation with the seller about it. But that's a big example. Maybe you do $420 with $20,000 back, right? And that makes everybody happy and comfortable. But just understanding that you can increase the purchase price and you can get some back, right? Property has to appraise. That's why it's got to be a good deal. And that ties back into the first comment. Now, number 3 is utilizing second mortgages. So, again, got to be a great deal. You buy the property for $4, it's worth $5. You go get your $300,000 bank financing, and then you go get a $50,000 second mortgage, for example. And now you're only 75% loan to value, or whatever that is, right? You're still not over leveraged because you're buying it at a discount day one.
Yeah.
So second mortgages are great. Pay a private investor 8, 9, 10, 11%. Whatever you got to pay. Again, you have to get the first position lender on board. So there's a hurdle there, but fundamentally, this is a strategy that you can use. And I'll give you one more just quickly, and this is for folks that want to raise capital from partners. You can put together a deal. Let's say, I keep using this example, so I'll keep rolling. You got this $400,000 deal. You get your $300,000 from the bank. You don't want to go the second mortgage route. There's no seller credit. There's no opportunity that you don't have a lender in your network that's going to give you a big loan. So maybe you go out there and you raise $50,000, right? Half the down payment from a private investor. Put together an operating agreement, contact an attorney to do this, and you're saying, hey, I'll pay you 12%, preferred return, right? Which is basically a fancy way of saying the first 12% in cash flow that we're distributing from this deal goes to you before I make any money, right? Mm-hmm. So it's similar to debt in that perspective. So you pay them 12%. They don't have any equity in the deal, but they're participating in the equity part of the capital stack. This is like real estate syndication kind of 101. A nice little junior varsity way of doing this. And then you only have to bring $50,000, right? And when you sell it, you pay off the bank, you pay off your investor plus the 12%, and then you own the rest of the deal or whatever proceeds
and then
come from it.
So essentially, you just redo the operating agreement at that point as a buyout. So you buy him out essentially. with the refi
Yeah, so
capital.
so
and then
you
own
write
the
you
property?
write into the operating agreement when you close that the first 50 grand that are due from a capital event, which is how it's defined in an operating agreement typically,
Yeah.
goes to the the investor, however your attorney dictates that terminology. So, and again, huge asterisk here. I'm not an attorney, so go speak with an attorney to do this. This is just all conceptual, brainstorming, right?
Yeah.
But
No, dude, I think this is genius. This is essentially
like-
a buyout, right? A buyout
exactly.
option.
It's
Yeah.
second position debt in the form of equity.
Yeah.
And this is pref equity, right? Preferred equity is a massive funding tool for large real estate investments where you have 75% as the bank debt, 10% as preferred equity at, you're getting the bank debt at 5, you're getting the preferred equity at 10, and then the rest of it is equity brought by the sponsor, the person who's doing the deal. And basically, as capital flows down the capital stack, right? First, the bank's getting paid, then the preferred equity is getting paid their required rate of return, and then what's less goes to the sponsor. And then same thing when the deal sells or refis. Bank's paid off, preferred equity's paid off. The investor at the bottom of the capital stack is left with whatever left. So it's basically, how you tactically do it is you can either just write it into the operating agreement up front, or you can create a mechanism that says, hey, when you're paid off plus your the preferred return that you're due, your capital account is at 0 and you're no longer entitled to any preferred return, and you're no longer entitled to any capital proceeds because we've satisfied your capital account. Then everything just spits back out. So
wow,
attorneys could draw this shit up
genius.
pretty easly.
Yeah, that's genius though. Wow, I think I might try to implement that this year. I've never done something like that with a buyout like that before. I think that's awesome. All right, man. I don't want to keep it too much longer. Let's just real quick. What is something that, somebody listening to this, tactical advice that they can do today to get one step closer to becoming a multifamily guy like you? Like, how do you get to your level? Is it analyze a certain amount of deals? Is it work on finding deals? What's one tactical thing that people can take away from this?
Wow, that's a really good question because I want to say like 40 things, but I think
you mean just go listen to everything that was already said?
yeah, go listen to every single one of my podcast episodes and Ryan's podcast episodes.
Actually, that's a good one. Why doesn't everybody just go listen to the Multifamily Wealth podcast? Because it's
there
pretty much
this plug, right? No, I think that the way I look at this, right, and I'm going to interpret this question for somebody who's newer in the business. They're getting started, right? Maybe they own a deal or a couple deals, but they haven't really done anything they haven't scaled or done anything big yet. Assuming that you really understand your buy criteria and how to underwrite a deal, like that is the equivalent of putting your pants on before you leave your house in the morning. Like if you're going to be a real estate investor, you have to know the numbers side of the business really well. So get that done, right? But that's kind of like an easy, everyone, just get that done. But the second thing is you need to really, really understand how to find good deals and how to spot the value in deals. And if you're in a position right now, if you're listening to this and you're like, oh, well, I go on the MLS once a week.
Yeah.
I got these couple of brokers. They send me some deals here and there. You can't compete. Like you're just not going to compete.
Yeah.
So you have to go out there. You have to network. You have to understand how to get in front of sellers if something you can do to generate deal flow in your target criteria, and you have to understand how to present offers and communicate well, right? So I think the tactical advice, because I told you what you should do, but how you should do that. This week, the next upcoming week, every single day of the week, you should be either speaking with a seller or you should be speaking with an investor that's active in your market. So you need to be building your database of seller contacts, and you need to be building your database of industry professionals, brokers, real estate brokers, mortgage brokers, other investors, people that are in the business that are watching deals get transacted. Do that once a day if you really want to get going. If you want to get to where you want to go twice as fast, do 2 a day.
Yep.
You should have 2 30-minute conversations every day with someone that you don't know. Like that's how you get to where you're going. It's volume. It's all volume, right?
Yep.
So
It's
you
gold.
do that for a month and be amazed at what happens.
Yeah, I agree. I actually do the same thing. I still have a spreadsheet, and I put everybody I know on the spreadsheet, whether they're an agent, investor, attorney, whatever they are, and I just have a log of like 150 people that and you know what's great about that is a deal may come around, and you might say, hey, I know this guy's looking for a deal in this town. And then next thing you know, you link up, and who knows, you might have a partnership with a partner or a lender that you never even knew was possible just because you met them one time. And so I think that's super powerful. All right, man, where can everybody find out more about you?
Sure. So, Instagram Multifamily Wealth Podcast is the Multifamily Wealth Podcast. If you want to get on our email list to see upcoming investment opportunities if you want to partner with us on deals in the future from a passive capacity. And you also want to get our really value-packed Multifamily Mondays newsletter, which I put a lot of time into. You can go to Aligned REP, which is short for Aligned Real Estate Partners, alignedrep.com/invest. And then if you want to shoot me an email, axel@alignedrep.com.
All right, cool. I'll put all that in the show notes. But all right, man, this has been fantastic. I think everyone's going to get a lot of great tips and tactical advice from this. So appreciate you coming on here.
Absolutely, man. Appreciate you having me. It's always good. It's always good chopping it up with you. So
yeah.
Hopefully everybody grabs some value out of this.
Yeah, man. All right, man. Appreciate it. Take care.
Thank you.